Okay, let's work through the TYUs again to kind of confirm knowledge. So we have a scenario here where, so whenever you see this type of thing, it says a company issues. So the company is borrowing money. The word issues here is they are borrowing money. They're issuing a loan note, so they are borrowing money. And what they've said is, listen, we will pay 5% standard on this on the actual note, so the nominal value of 20,000. So that's the loan note, and the loan note literally says, I owe you, student, £20,000, and I will pay you every single year 5% interest on it, and I will pay you back your money of 20,000 at the end of 4 years. And literally, if I'm going to be paying you your money at par, well, it means, right, that literally I'm clearing everything that I owe you. Every month, every year, I clear out the outstanding interest. So nothing, there is no premium. I'm paying you your interest every time. So the effective rate in it, I guess, suppose, is naturally 5%. So from a tabular, or should I say, let's do a double entry. I'll clean it at the end, but I'll show you. So of course you receive in the bank, debit bank, 20,000, credit the liability, 20,000. Then of course you have the interest accrue of 5% and 5% on 20,000, 0.05 times 20,000 is 1,000. So you will now have here finance cost. Remember, I'm recording this. I'm the one who's borrowed the money of 1,000. I'll just change my pen color here, and then what ends up happening is I pay you £1,000 out of the bank. So I have here, well, I already have bank account. I now pay you every single year 1,000 as promised on the coupon here. These are the little coupon slips that say that here's your 1,000. Come in and just hand me the piece of paper, the coupon paper, and I'll give you £1,000 every year for the next 4 years, and then give you your cash as well at the end. And that's how we roll every single year. So I'll have the carried down here, carried down 20,000, bring that down 20,000. And I do exactly the same thing, if you like, again. So I will always have these £1,000 coming out here. So that's how we deal with that. And at the end of the 4-year period, you would have paid off everything. So from a tabular point of view, it looks something like this: 20,000 plus the effective interest rate of 5%, 1,000, plus the coupon cash payment of 1,000, and the closing balance, of course, would be 20,000. And I'll do exactly the same thing again: 20,000 again, 1,000, 1,000, 20,000, and that's how I'd keep going. I'd keep going like that until I get to year 4, where I'd have 20. Oops, I'll just do year 4 here. 20,000 at the beginning, effective interest rate of 1,000, but this time I'd not just pay you your 1,000, I'd pay you your 20,000 as well, and all of that would settle that. And that's how I'd recognize that year on year. What we see here in question 2, so let me just clean my screen, and I'll take you to the answers because it's much neater there, but it's the same principle, and I think it's important you work through this yourself and build your answers. Here we have a scenario where you have decided to borrow 40 grand and you will not pay any interest at all. So of course there'll be a premium at the end. It's not just going to be the 40 grand you're going to pay me, right? Because you're not paying me anything, or you're not paying me that interest that accrues according to the you're basically not matching the coupon. Sorry, the coupon is not matching the effective rate of interest. Technically, if this was 9%, right, I would only be paying you back 40,000 at the end of your 3-year period. Sometimes it's better, I guess, using examples to explain this. 9% what I'd be paying. But because you've said you're going to pay nothing, the interest will accrue, and then I'll pay a premium, if you like. But that effective interest rate must still be recorded, if you like, right? So from a tabular point of view, what I have here is I have 40,000. Effective interest rate accrues of 9%, 0.09 times 40 grand, which is 3,600. You've paid me nothing, so you now have here 43,600. Then I carry on 43,600. Again, times the 0.9%, 43,600, and I have 3,924 and 43,600. So I have here 47,524. So you can see, of course, by the time I get to this is year 4 as well. So then I have here So I'm just going to do year 3 here. So I have 47,524. Again, multiply that by 0.09. 0.09 times 47,524. And I have here the interest accruing of 4277. Add that on to the 47,524. And I have here, all right, is it 3-year period? Oh, it's 3 years. Sorry, forgive me. It's a 3-year period. And I have here, I've arrived there, 51,801. Mine comes out at 801. But the key point here is you can see that the premium of 11,000 is on top of the 40,000. It must be because you paid me nothing to reduce that. I've already given you the idea that if you had given me 9%, we would have a different situation. Right, great stuff. And then, so again, like I said, I'll take you to the answers, but that's the principle. That's the way it grows. Right, and then finally, this is I haven't talked about this here, but this idea of a discount here, I want to talk about that. So say, for example, right, I come to you and I say, listen, I'm just going to pick Mr. Student, and I say to you here, hi, please, I want to issue you a piece of paper that says I will, lend me 20,000 now. So it's an IOU note that I, Oyen, will owe you. I imagine I'm Tesco's. Tesco's will owe you, student, £20,000, and I will give you religiously every period 4%, if you like, every year. That's what I've agreed. And you don't want to give me 20,000. There's a lot of better debt on the market where you feel that you'd rather invest your money. Or if you like, let's put it this way, there's an oversupply of people who want to borrow money, so to speak, or there are not enough people to demand it. So there's a mismatch between demand and supply. Or there's not enough demand, if you like. So because you need the money, you will give me that money at a discount. You'd give me the loan note, at a discount. I will still get this loan note. I'm still going to buy it. It's like any asset that has this. The value of this asset is 20,000, but nobody wants to buy it. So because you're desperate to sell it, you will sell it to me for less, which is what happens here. You sell it to me at a discount of 2.5%. So what you now have here is this person receiving. So if you take 2.5% off this, basically what's happened here is that the person who Tesco's issues this loan note, but they only receive in the bank 19,500. So they get 19,500. They recognize the loan of 19,500. But you see, here's the thing. The coupon says, this is what this contract says, is that you will pay 4% every year to the person you've lent the money from his interest. That's what you've said. That's the coupon rate, right? So that's what that must stand. That must stand. So the effective interest rate is already worked out for us. That's the setting, if you like, as to there will of course be a premium because you're not clearing. Look, this is 7%. You're only, if you like, deciding to pay 4%. In the same principle, like I said, at least you're paying something towards principal and interest. So let's look at it. This also brings in this question of issue costs. I talked about that earlier on. Because they're issue costs, and you've paid 534 issue costs, that 534 can be deducted against the loan, if you like. So at the beginning of the year, we have 19,500 of loan, less the 534. This has reduced the loan. Think of that as an initial payment of the loan. It isn't, but you can think of it like that. It reduces the cost of the loan. And I believe this is now what you now have here is 18,966 left. So we as usual record our 7% on that. So you take 7% on this, right? Because that's the finance cost. So it's the 19,500 minus 534. Right, 19,500 minus 534 is 18,966, and then you charge, of course, the interest of 7%. So you have a 7% charge. So you have finance cost of 1328. I'll just round that up, and you have a finance cost of 1328. You have agreed to pay 4% every single year on this 20,000. So you have agreed to pay. If you like, 0.04 times 20,000, which is 800. So you will pay every year out of your bank 800 towards this loan. And so I find my carry down balance and I just do exactly everything I've just done year on year. Right? Year on year. And that's what you do year on year. So let's just do that. Let's just do this one. So what do I see? I have 18966, in effect 18966 plus the interest that has accrued on it, plus 1328 minus the 800, which takes me to 19424. I'll just do that over here. So I now have a brought down figure of 19494. Forgive me. I'll do exactly the same thing. I will accrue interest again of 7% because this will accrue over the year, times 0.07, which is 1364. So I will have my finance cost for the next year. Finance cost will be 136. I'll just round up 1365, and then I'll pay my £800 out of the bank again. And just do the same thing. This was, how many years are we doing this one? This is for 5 years. I'm not going to do all 5 years. But the key point is, you can see I'll do my carry down again. And I'll come down again. My carry down is, I'll just do that. 19494 minus 800. And I have carry down of 20,058. 20,058. 20,058, and I'll do exactly the same thing. I'll find 7% of this and take off 800 and keep going, right? So you have your initial value, add on your effective interest rate, take off any cash payments. The cash payments are the standard 800, and it's always next to the loan note. It's the coupon rate, right? Same thing, coupon rate, cash payment every single year. Great stuff. Oh, sorry, they just wondered what happened for year one, right? So I didn't need to do that, but we stopped there. We did that already. That was year one. Those are the events of year one where we ended up with 19494. Awesome, great stuff. So yeah, and that kind of brings us to technically the recognition of these of amortized, and that's how we deal with anything that's amortized, which is literally over a long period of time up to maturity, and then we clear it, and that's what we refer to as amortized. Okay, see you in the next video.